everybody, and welcome to this version of Off the Clock with Your Attorneys. I'm Bill Demas. Again, it is my cohort, Warren Duffy, and we have a very special guest today. We'll let him introduce himself. We have
Adam Talley with Talley Insurance. It's good to be here.
And Adam, for our viewers, what type of insurance do you sell at Talley Insurance?
So we sell everything except for health insurance, but our main focus is property and casualty. So that's going to be home, auto, business, and then all the toys, right? All the fun stuff. So boats, RVs. I could sell you an airplane policy. I don't know if I'd have a market for it, but I'm licensed for that too. So
okay. So what we're going to do today is we're going to talk about what we call motor vehicle coverage or auto coverage. And then we're going to have a second part of this where we're going to talk about property, homeowners. So for right now, we're just going to talk about auto coverage. So as a little, peek behind the curtain, before Warren was an attorney, he also was an insurance agent. So they're probably going to have some hyper-technical talk, and I'm just going to sit here and look pretty while they discuss these things, but that's just the way it's going to be. So in the state of Florida, there is a law that you need some basic automobile coverage in order to own and operate a motor vehicle, right?
correct.
And what is that coverage?
So the two things that the state says you have to have is PIP, which is personal injury protection, and then you have to have property damage, right? And both of those would be at $10,000 limits. PIP is set by the state, covers up to 80% of your medical expenses or 60% of your lost wages if you include work loss on there, and then property damage is pretty self-explanatory. The title covers when you cause damage to somebody else, and the minimum is $10,000. I would say anything that is just PIP and PD, which is how the vernacular we would use, is substandard auto, right? And not that there's anything wrong with it. Sometimes that's all people can afford, but that's not really an area where we focus on, because really puts everybody at a disadvantage with that, right? It's really not enough.
So when you say PIP and property, that's just covering the person that owns the policy, owns the car, the driver, not anybody they hit.
So PIP is to you yourself as a policyholder, and then property damage would be to the person that you hit.
Okay. So that property damage isn't covering the car that you're in that you hit somebody with?
Correct. That would be comp and collision.
Okay.
Right? So if somebody, now you'll hear this term a lot, if somebody gets a car loan or something, they say, well, I need full coverage. Well, nobody's ever fully covered, so let's just start there. And there is no full coverage button, but when they say that, they're looking for, comp and collision and probably some bodily injury.
Okay.
With personal injury protection, you mentioned sometimes it doesn't cover things like your lost wages.
Correct.
So you can exclude stuff from personal injury protection.
It comes excluded unless you add the endorsement to have work loss included.
Gotcha. Do you see that as a benefit to make sure that most of your clients have additional coverage, or it's not really needed?
We, by practice, we always include work loss unless the person tells me they're retired, right? Then they don't need it because they're retired. No.
So where I want to go next, and you mentioned it, is bodily injury, or we term BI.
Correct.
Explain BI to us.
So bodily injury, it is usually split limits, right? So it'd be starting at 1020, which would mean 10,000 per person, 20,000 max per accident, going all the way up to 250,500, which is again in the thousands, so 250,000, 500,000, and then obviously above that we can go up to have an umbrella policy in the millions, depending on your needs there.
And that covers the person that gets hurt in an accident, right?
Yes, that would cover the people, when you're at fault, that covers the people that you hit.
Right. So that's not covering you in your car, that's covering the person that you hit in the other car.
Correct. And PIP comes first no matter what. So your own individual PIP is going to come before BI comes into play.
Now, when you said property, that was property for the vehicle that you hit.
Correct.
And then you talked about comp and collision.
Right.
Explain the difference between property and comp and collision.
Okay, so comp and collision stands for, comp is short for comprehensive, so let's start there. Basically, it just comes down to if vehicle's moving, call it collision. If it's not moving, it's generally going to be comprehensive. When it does that does also include your windshield claims, right? So in the state of Florida, so long as you have comprehensive coverage and you have a crack in your windshield, there's no deductible. They will replace it for free. Now, that is still a claim. That's what some people need to understand, because they think, oh, well, I don't have a deductible. Windshields are free, right? Well, windshields aren't free. So as far as the cost to the carrier, and what we're seeing is if you start having a lot of windshield claims, that's going to rack up on your, as far as your premiums concerned, and, could affect your ability to get insurance if you have a bunch.
So you're seeing increases in premiums from a windshield claim.
We are.
Just like they had an accident, or not to the same extent?
Not to the same extent, and it's usually, I don't think one is going to kill you. But, if you have 3 or 4 in the matter of a couple of years, there's a pattern there. Something that you are doing or some path that you drive consistently is kicking up something that's causing those claims, right? And on the other side of that, when it comes to the windshield claims, unfortunately, like everything else in our state, there's the 1% of bad actors that kind of ruin it for everybody else, right? So, I was going through a client's policy, and I saw they had multiple windshield claims in a short amount of time. And these claims had an attorney involved. They were like $5,000 claims for a windshield, things like that are just not they were out of place, right? Like something didn't smell right on that. So we've even seen some of that when it comes to windshield. So there's some fraud involved with that as well.
The comp and collision is for your
vehicle.
Your vehicle. Something falls and hits your car.
Right.
You're parked in a parking lot and the light post falls down and hits your car. Or somebody hits you in the parking lot and then drives away. That's going to...
So if somebody hits you in the parking lot and drives away, that will probably still fall under your collision. Now, the lamppost falling over like you're talking about, I would probably tell the person to file a claim with their own carrier first, just because that's the fastest way to get your car repaired. But what's likely going to happen is, the parking lot that you're in is going to have some liability exposure, because let's face it, lampposts aren't supposed to fall down, right? So what would happen in that case is your carrier would subrogate against the parking lot owner's carrier on their general liability policy to collect the money back on that side.
Okay. Well, after that, there's something called UM. Can you explain that?
Yeah, UM is going to be uninsured motorist, right? And that's coverage for you when you're not at fault, right, in the accident, but the person that hit you is either uninsured or underinsured, right? And generally, we like to see those limits be the same as your bodily injury limits. But we do have some people that, the other things are absolutely necessary in my mind. And I think uninsured motorist is extremely necessary. I think it's one of the most important. But when we're in a situation like we are right now economically, we do see that that's the first thing people do when it comes to either excluding it or reducing it, right? They rather not get sued, so they'll have the higher limits on the BI, and then they'll worry about themselves, on their own when it comes to the UMs. We have seen that. Conversely, you can get more uninsured motorist than your bodily injury if you do something called stacked, right? And stacking is very simple. It's just, it stacks on top of each other based on number of vehicles, right? So if you have, we'll just do the simple math. Let's say you have 3 vehicles and we have 10, 20, uninsured motorist limits. Well, if it was stacked, you'd actually have 30, 60, right? So that's how it add up.
How does it work with a motorcycle?
So motorcycle policies are different. You don't have to have PIP for motorcycles. So that would just be your standard, it'd be more just liability. We do see, so with golf carts, if they're not street legal, we write that on a motorcycle policy.
If they're not street legal, then...
If they're not street legal, they're on a motorcycle policy. If they're street legal, they need PIP, so it needs to be on an auto policy.
So let's talk about golf carts, because there's a lot of golf cart communities around here.
Correct, yep.
I live in one, Warren lives in one.
Wonderful, congrats.
And by golf cart community, that doesn't mean that we're, in a retirement community. It's just...
They're not in Sun City.
Right, we're not in Sun City.
Which could be.
Or in the villages. We are...
Fine places to live.
Fine places to live, but there are places like downtown Dunedin and Palm Harbor and other places, Gulfport, that allow you to ride around in your golf cart.
Correct.
And a lot of these people are jumping in these golf carts that are not street legal, and they're zipping around with them.
Correct.
You would suggest that they get insurance under a motorcycle policy?
That would be how we'd write it. So when it comes to street legal golf carts, we have an extremely hard time finding coverage for them, right? Because you got to think it's made to go on a street, but it doesn't have the same safety features that even your most basic cars from 15 years ago have, right? Most importantly, doors, right? So if somebody hits you with their car, that's their car right on you, right? Without any protection in between. So it's a riskier risk, so to speak. So we have a really, really hard time with street legal. When it's not street legal, they're usually, can't go more than 25 miles an hour. So we know they're going at a lower speed. And that's why we can do it on the motorcycle policy.
So when you say street legal, let's say that you have a golf cart that's street legal, meaning has the lights, has a license plate, but it still really doesn't go over 25, 30 miles an hour. Does that factor into it?
So the demarcation point on street legal is registering it with the state, right? So if you have to go down to the DMV and register it with the state, and even though, maybe a non-street legal one might still have the seat belts and the mirrors and that kind of stuff. As soon as you register with the state wants you to have PIP and PD. Can't get PIP and PD on it, or we can get PD, but we can't get PIP on a motorcycle policy. And then most carriers don't want to add that golf cart to your regular auto policy.
So what do you do in that case?
Unfortunately, I recently haven't had any luck finding a place to put those. I have to send them somewhere else. Mm-hmm. Because the other thing that we're seeing, and this is, not necessarily on this topic, but it is on the larger, auto topic as a whole, is, very similar to what's happened over the last couple of years with homeowners, where carriers are getting super restrictive on what they want to take on new business, that kind of stuff. Of the 12 carriers that we have on the auto side, over the last, quarter or two, we've seen probably 75% of them severely restrict new business. Most of them don't want to take on anything new. And then the things that they are taking on, I got a note from one of our reps from one of our carriers, a large national brand that you've seen commercials for, and they don't want to take 250, 500 anymore, right? They want to keep it, they still want standard and preferred, which is, that it's kind of, conflicting information that they want, but they don't want to do 250, 500. They want to stay in that figure range. So if you wanted higher limits, or if you want an umbrella policy, you might not really have that many options.
So going back though
and that's just for normal cars, not golf carts. So imagine amplifying it with golf carts, right? So,
yeah, that's pretty heavy restriction.
Yeah.
Going back to the motorcycle part of it, what other different types of coverages can you get on a motorcycle policy, since it seems to be a little different than an auto policy? What are the differences?
So it's carrier specific, but most of them it really does align with what you'd see on an auto policy. It's just they don't have PIP. That's really the main difference, is they don't have PIP. They might have extra included stuff for customization, but then when you get into the rating side of it, they might have a restriction on the level of on the size of the motor, right? The CCs. Okay, so they don't want something that's going to go 200 miles an hour down interstate. And we're seeing that with boats too. A lot of them on the boat carriers, they don't want anything more than 30 feet or more than 400 horsepower. And if you've seen a lot of the boats these days, they are all about 30 feet and have more than 400 horsepower, or they'll limit it to $100,000 on the value of the boat. Go try to buy a boat brand new. I mean, even a small boat that would fit under the size and horsepower requirements might be $150,000, depending on the style of boat that you want. So it's seeing a lot of tightening on restrictions really across the board on most risks, unfortunately.
So you've mentioned a couple things that I want to circle back around to, including umbrella and excess and stuff like that. But there's one other thing that I want to talk about, basic for policies, med pay. What is med pay?
So MedPay is medical payments, right? And it's again another coverage to help you when you are injured in an accident. Now that is something that we don't see, purchased quite a bit anymore, and because people look at it, well, I have I have PIP, and pretty much everybody these days has health insurance, whether it's good or not. That is what it is. So I would say 95% of policies we write and or see come in don't have MedPay, and if they do, it's $1,000 or $5,000. It's not much, right? So it's a very I would say that's going away, right? I think that was more of something used in the past when maybe health insurance wasn't as prevalent, when the Obama came in and kind of required everybody to have it, and then opened up the healthcare.gov site and all that stuff. It kind of eliminated some of that stuff.
Okay. Now you said a couple of times about umbrella. What is an umbrella?
So an umbrella policy is an excess liability policy that would go over your auto, would go over your home, would go over any rental properties that you might have, boats, motorcycles, everything else like that, right? And what it does is it takes your liability from whatever the underlying limit is up to, $1 million all the way up to $20 million if you can prove that you have the need, right? They don't just like giving that one away, but getting $1-2 million is pretty common.
Now for those, it's my understanding, which kind of runs into what you were saying, is that they have requirements that you have a certain amount of underlying coverage. Sometimes you need your basic policy to have 250, 500 before they write an umbrella.
Correct.
But then the underlying carriers won't write 250, 500. So how do you write an umbrella?
Correct. You pay for it. That's the thing, right? Like sometimes it's cost prohibitive, but if there's a need, then when you have assets to lose, then you pay for it, right? A lot of people, and really what it is comes down to, it's similar to where we are with homes, which we're going to talk about in a little bit here. It really just prohibits your mobility switch. So, so my wife and we have 250, 500, right? And we're in our 30s, so you would think my rates should start going down. They haven't. But if I go to shop myself, I can't beat my own rate, right? Because nobody wants to take it. So that's the other thing is you're probably stuck where you're at if you want to keep or you're going to pay more, to switch typically. So it's not, it makes it difficult. Now I will say, and then one of the other things that we'll talk about when we get to property is citizens, right? And citizens, their liability limit is $100,000, right? And most true umbrella policies and carriers, they want you to have $300,000. So we are either writing an excess liability policy specific to that property to go from 100 to 300 so they qualify, and then the umbrella picks up from 300. Or I do have one carrier right now that will do, they'll do it over 100,000 if it's your primary. So they'll take a citizen's policy essentially, and they'll do 100, 300. So I have one carrier, but it's, you're always subject to the underwriting guidelines changing. And if they come back next year, your renewal, and say you have to have 250, 500, then you either got to increase it or, you don't have the coverage. You lose the coverage, you don't qualify.
So, and you said before that there is no full coverage.
It's impossible to be fully covered.
Right. And now that we've talked about all this, maybe we can give the people context. And I know that's when I said that to Warren, that was kind of his little...
I laughed too.
Yes, so why don't you guys discuss why that's almost impossible?
I mean, it's a pretty subjective term in my opinion, but everyone thinks it means something a little bit different, and it doesn't address the quantity of coverage that you have.
Yeah.
It just checks some boxes.
Well, and let's go even deeper on this, and this is why you guys have jobs in this field, is every policy, no matter what, has exclusions, right? There's no policy without exclusions, and there is no, people like to call me and say, well, what about this and what about that? And my answer to them is, it's going to depend. I'm not a claims adjuster. I'm not a licensed claims adjuster. That was always my precursor to any talk about what, when, and if coverage applies, because I'm not the one determining it, right? I'm trying to sell you the best product I can and give you the best knowledge. to the best of my ability. But every claim scenario is specific to that claim, right? And we all know the mitigating factors that would ever go into that specific scenario. So it's impossible to sit here and say, even if you have 250, 500 and you're fully loaded, it's impossible to say that that policy is going to pay for a single time that you have an accident, right? I mean, more likely than not it will, but I can't say with 100% certainty. And I think anybody that does, I don't know if they're giving you the right information, because that's why people have to call you guys, right? Because things get denied, and sometimes they call you and you have to give them the unfortunate news that there's nothing there.
Yeah, there are a lot of times to talk to those people that have an accident, and we can't help them because that policy is very clear. It's just not covered. For example, other drivers in the household that are driving that vehicle but they're not on that policy, that is usually a complete bar to coverage in most cases.
Well, and I'm glad you mentioned that, because carriers are getting extremely, extremely tight and on drivers. It's not even drivers. It's people in the house of driving age, right? So like that's how the language is written now is have you listed all members of the household of driving age? So basically anybody 15 years or older, whether they have a permit, a license, whatever, they want them on that policy. And technically, we've had some carriers come in and reps, say this to us. Technically, let's say Warren, you and I are roommates. I would technically have to list you on my policy.
Yep.
I don't have to list you as a driver, but I have to list you as a household member, right? So, but if you're listed, you're either a driver or you're excluded. So the kind of going back to what you're saying, there is maybe some gray area where somebody's in the house, but they're not on the policy. That's why they want to put them on there, because they want you to either rate for them or fully exclude them, which means that, I exclude you from my policy. I'm parked behind you, so you got to back my truck out in the morning, and I'm not there.
Yep.
So you back my truck out, you pack it into the neighbor's car. We are SOL, as they say.
No coverage for that one.
No coverage, right? So
and that takes me to the next point, is that people think they have insurance, just like with the windshields, right? And they go, okay, well, I bumped this, I did this, I have insurance, I have a low deductible, I'll make a claim so it's not out of my pocket. But those affect your ability, A, to get insurance at the current rate that you're getting it at, meaning cost, and B, could even affect your ability to get insurance in the future.
correct.
So are there times where you just, your kid backs up the car and dings the neighbor, and you go, hey man, let's just go down to the auto body shop and get it fixed, and no harm, no foul type of thing?
Yeah, and I would especially say if we're talking about the scenario where, like, you're backing a truck out and that other car's parked, right? So there's nobody in the car to where you would have maybe that extra liability exposure from an injury standpoint. Yeah, I see that all the time where people are like, oh, yeah, I did that. I wrote him a check, we took care of it, we're friends. And on the flip side of that, we see some people with a lot of regret on things that really weren't that expensive, but they just wanted to file the claim, save a couple $100, and they're like, I should have just paid for that because now I'm paying for it.
Right. So let's move that into deductibles. Okay. Because that's the one thing that we've mentioned, but we didn't really hit.
Correct.
So explain what a deductible is on the policy.
So a deductible is your out-of-pocket cost, right? So common deductibles, we mostly write $500 deductibles. It's, the most common that we see. We do see some people that, especially on the homeowner side, because there's a lot. Let me stop where I'm at right there. So it is really interesting because your auto insurance is probably more costly than your homeowner's insurance, without a doubt. Like if I had to guess, most people in this room, their auto insurance costs more than their homeowner's policy, unless you live in a mega mansion. But they really nitpick the homeowner's policy apart on price. But, they see the value in auto because they see accidents and all this other stuff, right? So we do see some people that want to go with a higher deductible because they're like, well, if it's anything less than this, I'm not going to file a claim anyways. So why am I paying for it? The issue is, on the auto side at least, or not an issue, but something to think about, is generally it might not make that big of a difference monetarily. right? Now you might still not want to file that claim if it's only $1,000 or $1,500, or if it's just cosmetic, you might just leave it, right? Like I drive a pickup truck, I got a few scratches, but it's a pickup truck, it's supposed to have some scratches, right? But to go from 500 to 1,000 or to 2,000, so now we're quadrupling your out-of-pocket expense. I'd say be $100 every 6 months, maybe. I don't know if that's monetarily, it doesn't make sense to me sometimes. So that's where we like to go through, and the best thing with that is to live action rate the policy with them. And I just give them their choices and let them make the decision, right? I try not to steer anybody in any direction, because at the end of the day, I'm not the one that's going to be paying for it. So it really has to come down to what they're comfortable with.
So that's real interesting with me, because I've always thought, again, not being in the business as you guys, just being a consumer, that, listen, my wife and I are blessed. We both have good jobs. That literally, if it's under $2,000,
right,
or $2,000, I'm not going to file a claim for it. I'm just going to take it to Robert's Collision, which has been in the name for 50 years, and at least, and I'm going to have them fix it. They do a great job.
Straight shooters, I like them.
Right. I'm going to be done with it. I'm not going to mess around with an insurance claim over it. So that's always been my deductible, because I'm like, well, I'm not going to file a claim for under that anyways. And I thought it was saving me a bunch of money. It may not be saving me a bunch of money.
It could, and you just got to look at it. Well, how many of the savings do I, like, term-wise, do I have to do before it's paid for itself if a claim happens, right? So, for instance, if you're going from 500 to 1,000, and it's only saving you $100, right, per term. Well, after 5 terms, it's paid for itself. You save the money, and now you're saving the money in the future, right? So it could still do that. But you can't predict frequency, right? And that's the other thing. So a lot of people, well, I've never had an accident, and then all of a sudden we have 3 in a row in 2 years. That's poor luck on that one.
So the other thing I want to bring up, and of course I'm not smart enough to have pulled this out, but it was something that Warren wanted to talk about, was people get on the internet and they search for zip codes with the lower insurance premium.
Okay.
And then they have an auntie or a grandma that lives in Spring Hill or whatever, so they use that as their address for their auto insurance when they really live in downtown St. Pete.
Right.
Besides being
fraud,
highly illegal, and insurance fraud, which is a felony in the state of Florida, so don't do that.
3rd degree at minimum, I believe.
Yes.
Yeah.
So that alone should stop it. But Warren also pointed out, and I want you guys to discuss it, that the police don't only come get you, you now have no insurance coverage. That avoids your coverage.
Correct. Yeah, and it's called rate avoidance. And I have, an acquaintance that he's like, hey man, can you help me out with insurance? I'm like, listen, I've been to your apartment. Your policy says Panama City. I'm not writing your policy. I'm not losing my license for you to save a buck.
Right.
Right. And I'm very straightforward and clear with him on that. Because when something happens, you're screwed, right? Unless you're top of mind thinking about it. But, are you going to lie for your driver's license at that point too? Then every government document that you have is a lie. So when things hit the fan, you are really, really going to be in a world of hurt, right? And yes, that would be material misrepresentation is how I would assume they would qualify that. And every single application asks, have you ever been canceled for insurance fraud, material misrepresentation on a application or a claim, right? So basically, if that happens to you, you are done.
You have to answer yes, or you're committing insurance fraud.
Or you're committing fraud. Correct. Yes.
Yeah. That's all pretty cut and dry. You can't do that. But how does it work when, say, Bill's insuring his kids, but they're off at college, so they don't live in the zip code? We got to take that into account somewhere.
Correct.
Right?
Yeah. So there's vehicle location, which you can do, right? But then again, you're rating it properly at that point. So for instance, you said your son goes to FAMU, right? Tallahassee, surprisingly lower rates than Tampa. Okay. So I would put that if he has a car with him, you'd either put, okay, well, that vehicle is in Tallahassee, and you put that car in Tallahassee, which is the proper way to do it, and it's going to save you money. Might not, but you got to do it correctly anyways. The flip side of that would be, my freshman year of college, I didn't take my car with me. I wasn't allowed to. So what we did there is then you have an endorsement you can do that is a student away at school. Mm-hmm. And the range is more than 100 miles, right? Which basically means, okay, this person, they're in the household, but they're not really in the household. And they assume, okay, well, they're going to drive on Thanksgiving break, Christmas break, maybe over the summer, but they're not really a true household member at that point. The other thing that you can do, my clients with kids, because if you have a youthful driver, you're $10,000 a year probably on your auto insurance.
I have 3 children, all in college. I have 2 21-year-olds and a 20-year-old. So
I'm glad that you're an attorney. You can afford it. So the other thing that you can do that does help is, and again, like, not everybody can afford to do this, right? Like, not every car is paid off. But what my parents did for me, and I'm very thankful that they did this for me because it taught me a valuable lesson that's helped me in sales. But when I went to Florida State, my car was paid off. They put the car in my name, and I got my policy in Tallahassee. So then my entire policy for my car, now I'm not Adam Talley living in Apollo Beach, I'm Adam Talley living in Tallahassee. And so when you do that, your 21-year-olds, they don't have any assets, right? They don't have anything to lose. They don't need $250,500. They can probably get away with $2,550, right? So in that case, they can get a policy that's probably going to save you money overall because, it's in their name. It's you send them off, right? But you got to put the car in their name too. It can't just be paid off. It needs to be in their personal name. So that's another thing that we see, especially if they go off to college in a different state. Florida has the highest rates in the nation, right? Some of the highest, depending on the risk. But so if you're going to school in Kansas, pay that car off. Let them get a policy in Kansas. It might be like $500 for the year, not $5,000, which it is here. So, and I know there's attorneys there too. So I don't know how that works, but it's that's what we see with those youthful drivers, is trying to get them on their own is the real key to savings.
Anything that you want to add, Forrest?
I think we've got to ask that question we've asked most of our guests. What is your messed up story that you talked about? What's your auto situation that you looked at and went, oh my God, how did this happen? How did you get this policy set up like this?
Well, we did talk about the one scenario where that acquaintance wants me to write that policy, and I told him to pound sand. So there's that one. On the auto side, I've been thankful I don't really have any like crazy out there scenarios because we don't really deal in the non-standard market, right? We're not writing PIP and PD policies to where we have those sort of incidents. Very thankful that our clients are in a different sphere, so I don't really have too many stories on that side. Now, what I will say, the one unfortunate thing I had is I had a guy, single parent, 2 children. Both children had 2 accidents, and he had 2 accidents over the course of 2 years. So 6 accidents, 2 youthful drivers, all on the same policy, premium on the term before it got non-renewed, and it was with Progressive, which is one of the more accommodating carriers, or used to be. It was like $17,000 a year, got non-renewed. I didn't have anybody that would take them. He had to go to the JUWA or whatever. Okay. Yeah, the Joint Underwriting. I don't even know the acronym because I've never had to deal with it before.
It's like Citizens for the auto.
Correct,
You can't get anyone else. You get to go here, and it is ugly.
I believe he's paying about $25,000.
And cheaper take Ubers.
He seriously considered it.
So let me ask you this. As a wrap up, what carriers do you write policies for? I mean, who are your insurers that you represent and write policies for, and for the auto?
Oh yeah. So for auto, we have, auto in Florida, we still have all the big national brands, right? So we have Progressive, we have Safeco, which is owned by Liberty Mutual. We have Farmers. It's foremost in Florida for the independent agents, but it's owned by Farmers. They bought the MetLife book, so that's how that got converted over. We have Travelers, we have Mercury, we have Hartford, Nationwide, of course. Mafre, we still have some policies with them. They're an international company that y'all really see a lot. I feel like I'm missing some. We have 12, and I feel like that list is incomplete there. But
does every carrier have kind of a different type of customer they're looking for? Is there a different mindset for them all, or are they all pretty much the same?
Great question. Appetites are always changing, you get a lot of carriers that they used to want that, ultra preferred, right? They wanted the 100, 300, the 250, 500. Now you're seeing they want that sweet spot might be 50, 100, where their appetite is. So I would say no carrier follows the same model, and I would say their appetite changes based on where they're at book-wise. The fact of the matter is, and this is very similar on the homeowner side, not a lot of carriers are in the black in Florida. So you can't operate a business with a deficit, right? And they can only balance the Florida book with other states for so long before it doesn't add up. So that's why we're seeing the restrictions is, losses, right? It's a math equation at that point. Not any other business couldn't stay open that long if it was losing money, unless it's a startup for some reason. I don't know how those lose money and still keep going. I don't think Uber's made a profit yet, but they're huge. They're huge. Well, so while we're talking about Uber, we're talking about auto insurance. Before we move on to homeowners, the thing with Uber, from what I've been told, is that the reason they're still getting all those investments, even though they're losing money, is that they're waiting for the autonomous vehicles. Because once their biggest cost right now is drivers. Once all the vehicles are autonomous, it's going to be nothing but profit.
That's good for them.
That's good for them. I would maybe buy the stock in a couple of years.
If you do drive for Uber, though, you've got to have a little different insurance. You can't just be doing the same insurance like I do. I drive to and from work, but non-family members or friends in my car, that's a pretty big risk.
Yeah. So they'll have, and same thing if you're like a delivery driver,
okay,
right? You deliver pizzas. You're just on the road more. So that is a underwriting question, and they rate for it. I'm just going to pay more, but you got to have it. Similar to now, Safeco is pretty good about this because their Liberty Mutual is a partner. But Turo is a place where it's like Airbnb for your car, right? I could rent you my truck if you wanted to. Really, really not a lot of carriers want that. Safeco has a really good product for that because they have that partnership. So depends on how many vehicles you have and how it's going. So, yes.
That's a bad situation.
It is. I would like to not be involved in that legal dispute when that happens. Some of those providers have their own insurance that you would go to if something did happen, right?
Yep.
So that's the other side of it.
Well, Adam, thank you very much. We're going to end this segment. There's going to be another segment, another video that we're going to talk about property insurance. When you tune in, we're all going to be wearing the same thing because we're going to do it right after this one. So, yeah. So, Adam, if they have any insurance questions, where can they get in touch with you at?
Yeah, so our office is located in Brandon. We've been there for 40 years. Actually, this is our 40th year, started in 1983. So you can find us there. You can find us online at ctalleyins.com. That's C like Charlie, TALLEYINS.com. And then, of course, you can call us 813-685-9393.
Okay. And again, I'm Bill Demas, and this is Warren Duffy from Herman Wells. If you have any questions regarding any insurance matter, or if you're in an accident or injured either due to the fault of somebody else's, or even if you were in a car accident yourself, please give us a call, 821-3195, and we'll be happy to answer those questions. Again, call Adam before the accident with insurance questions and call us after the accident.
Yes,
with
don't do the
insurance
reverse of
questions.
that. It's not going to be very helpful.
Well, thank you very much, and we'll see you next time.